Let's continue with this question. April 11th, paid Green Manufacturing the outstanding balance on our account. How much do we owe Green Manufacturing? Let's use the three-step process. Step 1. Do we get the discount? Remember that we received the inventory on April 2nd, and the terms are 210, net 30. That means we have until April 12th to take the discount. What is today's date? April 11th, so we can take the discount. Step 2. What is the amount of the accounts payable? Always take the original invoice, subtract any returns or allowances to determine the amount. In this case, the original invoice was $4,900, and we have one return for $100 and no allowances. So the amount of the accounts payable is $4,800. Step 3. How much cash are we going to pay? And what's the amount of our discount? We take the accounts payable amount from step 2, multiply it times 100% minus the discount, which remember is 2%, and that equals the amount of cash that we have to pay, $4,704. What is the dollar amount of the discount? Take the amount of the accounts payable, $4,800, subtract the amount we're going to pay, $4,704, and that will tell us that the amount of the discount is $96. We now have exactly what we need in order to make the entry. April 11th. What did we get? We got back our IOU, so accounts payable disappears. Remember, the amount is $4,800. We calculated it in step 2. What do we give away? We give away cash. Remember that we're not going to give away $4,800 cash. We only have to pay $4,704. Where does the discount go? Well, what did we get? We got cheaper inventory because we got to take a discount. Remember, inventory is equal to the acquisition cost, and it no longer cost us $4,800. It only cost us $4,704. So that lower cost has to be reflected in our inventory account. Credit inventory, $96. Update our inventory T account, $96 credit. Let's just move the question up a bit. April 13th, purchased inventory from Knight Sports Limited for $920, cash on delivery. The inventory was shipped FOB destination. Well, that makes sense because it was cash on delivery, so as soon as they delivered it, they required us to pay them cash. That must mean that they were responsible for the shipping. What did we get? We got inventory. And what did we give away? Cash. April 13th, we got inventory, $920. We gave away cash, $920. T account, debit inventory, $920. April 14th, the appropriate party paid $35 freight on the purchases from Knight Sports Limited. Who is the appropriate party? Knight Sports shipped it FOB destination. That means that they're responsible for the inventory while it's in transit. They're responsible for damages that happen to the inventory in transit, and they are responsible for paying the shipping fees. Therefore, April 14th, no entry. April 17th, purchased supplies for $1,300 cash from Office Supplies, Inc. Why do we have an office supply entry in the middle of our inventory entries? That's because often students, when they're in an inventory question, they just start putting everything to inventory, but not everything we purchase belongs in inventory. Supplies are things that we will use or consume in order to run our business. Therefore, supplies should be recognized as a non-inventory item. What did we get? Supplies. What did we give away? Cash. The asset account supplies increases by $1,300 and cash decreases by the same amount. No update to the T account for inventory. April 18th, received a $110 cash refund from Knight Sports Limited for inventory that was damaged in transit. Are we permitted to return the inventory? And the answer is absolutely. Don't forget that this inventory was shipped FOB destination, so it is the shipper's responsibility if the inventory was damaged in transit. Because the inventory was damaged in transit, we have no responsibility and we can ship it back to the supplier. Knight Sports Limited. So what did we get? Well, because we paid Knight in cash, we're going to get cash back. What did we give away? We got rid of some of the inventory because it was damaged. Debit cash, $110. Credit inventory, $110. Update the T account. Moving on. April 20th, sold merchandise to sports retail for $6,800, 110 net 30. The cost of the merchandise was $4,080. Shipping terms were FOB destination. Let's do the entry. April 20th. What did we get? We got the legal right to collect cash from our customers at the selling price. That's accounts receivable, $6,800. What did we give away? We delivered a product which gives us a right to claim revenue, sales revenue, $6,800. We have to do the second entry. What did we get? We got the use of inventory to help us generate revenue, cost of goods sold. That's for the cost of inventory, $4,080. What did we give away? We gave away some inventory, $4,080. Let's update the T account. Inventory reduces by $4,080. The appropriate party paid $100 freight on the shipment to sports retail. Who was the appropriate party? It's FOB destination, which means that the shipper has to pay the inventory costs. Who is the shipper? Well, we are, because we shipped it out to our customer, sports retail. Let's record it. We're going to move to a new entry field. April 21st. What did we get? We got the use of a shipping company in order to help us generate revenue because we sold something. That is shipping expense, $100. What did we give away? It said the word paid, so we know we gave away cash, $100. No entry to the inventory T account. This video is getting a bit long, so let's continue with this problem in the next video.